Hi there. My name is Kent Skornia, President and CEO of Krilogy, and this is my partner, John McArthur, Chief Investment Officer here at Krilogy. And this is your February market perspective. Johnny, great to be with you. Here we are every 4 weeks, pumping out these videos and giving people market updates. Happy Valentine's Day, by the way. It's February 16th. I say that Valentine's Day is also my wife's birthday, so
smart man.
Double whammy for me. But let's just get right into it. Where are you at with the markets? What's your team seeing out there? Talk to us about the overall sort of position of the markets today.
It's interesting. We were in our daily investment strategy meeting yesterday, and there's this narrative out there where technical analysts, Jamie Setley, our director of technical research, is very bullish. Technical analysts, broadly speaking, are very bullish right now because we're seeing really pretty meaningful breadth and participation in the market now for a number of months. We're seeing higher lows. We're seeing more stocks make 52-week highs than 52-week lows. So those are all really positive developments. Yet there's just a significant lack of distrust, and the fundamental analyst will say, "Don't fight the Fed." So right. The technical analyst will say, "Don't fight the trend." Fundamental analysts will say, "Don't fight the Fed." So we're in a really interesting environment with a lot of negativity that still exists.
And yet the market is up since October.
It is.
And then it goes to the old saying, "The market climbs this wall of worry."
Right. So. Exactly. Yeah. There's, the setup for the beginning of 2023 was really a contrarian positive setup with so much pessimism built in. We had really historic tax law selling that took place in December of last year to, put the market down 6% or so in December, which typically doesn't happen. So the setup was there for whether it's a bear market rally or the start of the first leg of a bull run, unanswerable at this point, but it's been really positive. I mean, the S&P's up, 7 to 8% or so at this point of the journey, and
volatility in the bond market is step back more.
I think that's one of the biggest positives. If we look at really the context of the October lows last year, that was in the face of rising U.S. dollar and more specifically rising interest rates. The 10-year hit 4.25, really at its highs. We rolled back over from that period of time, but over the last few weeks, we've seen real strength in yields and interest rates rising again. I mean, the 2-year Treasury is back up to former highs. The 10-year seems to be heading in that direction. The 10 years at 380 or 385, and yet the market is dismissing it. So that tells us that a lot of the damage has been priced in. Yeah. And really it's less of a story about where's the Fed and what are they doing, but it's really a story of what are companies doing? How healthy does the consumer remain, and what is the corporate earnings outlook?
Absolutely. So we'll get to earnings here in a second, but let's stay on the Fed conversation, because that's, when you open up your paper in the morning, your website, you turn on financial news, you hear, what's the Fed going to do next? Where's CPI next? Where's inflation coming in next? Yeah. Well, what's your thoughts and angles there?
Yeah. Well, the market went from pricing in 50 to 75 basis points of cuts in the second half of this year, which was a disconnect from what the Fed has been saying now for a while, to really the market and the Fed on the same page in that respect. I mean, the market is no longer pricing in rate cuts in 2023, but yet it still remains strong. So that's really a positive sign. We've seen higher headline CPI, core CPI, not higher, a little firmer, stickier than anticipated. PPI this morning, producer price index, kind of ahead of expectations on the high side. So disinflation is happening, but there's
only
a
in pockets.
There's a stickier element.
Absolutely.
And that very well could be the Fed maintaining, hawkish policy for longer. And
the market has to digest that, get used to
that's
that.
right.
Sort of, there's a different set of rules than the anticipated. Oh, at some point the Fed's going to turn and actually cut rates.
That's right.
Yeah.
So, when we look at that backdrop, I mean, with, from an investor perspective, the tendency or the temptation, which makes sense in part from a portfolio strategy, is to look at the 6-month treasury yield. It hit 5% for the first time since 2006, the 1-year treasury at 5%.
Yep.
Again, haven't seen that since 2006. So the temptation is just to grab and settle there, but there's plenty more that can be done from a portfolio strategy perspective, because that will be short-lived. If we in fact get a recession, perhaps later than many anticipated, but yet still may happen, with an environment that's characterized by not only higher rates than what we expected, or that many expected, or the market expected, but higher for longer, could cause problems. But,
yeah, and now you get back to earnings and corporate earnings, right? Because that's actually what drives stock price.
Yeah.
Corporations are now getting used to this sort of higher interest rate environment.
Yeah.
How do they decide on where they're going to spend their money?
Mm-hmm.
How do they, in a higher inflation environment, do they push those prices down to the end user and the consumer?
Right.
And I think they've gotten to that sort of, as long as they know the game they're playing, they will find a way to make money. Particularly now that it's a little bit more predictable that these rates might stay higher longer.
Right. Yeah. And companies have by and large been successful at passing on those costs, but now in a more of a disinflationary moment, which has been happening for months now, it's reasonable to expect margin compression. You've got stickier elements, wages and so forth, that aren't rolling over.
That's right.
Yet pricing power isn't maybe as strong as it had been prior. So companies navigating that is really going to be the question going forward. And I think the other thing that we discuss and have discussed really for years is the amount of companies that exist, zombie companies in the universe, which is, companies with higher cost of debt service don't have the profits to meet that debt service.
Right.
And the number of those companies as a function of, zero interest rate policy for a long, long time, 10 years plus, they've increased over time. And so far there aren't signs of macroeconomic stress and issues for those type of companies, but it's reasonable to assume or expect that occurs as we get further in this process. Because again, Fed has hiked 450 basis points in less than a year, and that's historic. And that puts pressure, and it just hasn't shown up.
It hasn't shown up, but it will, because if you're over leveraged and your interest rate goes up on that leverage, it's just a matter of time, which gets us back to the quality of company you invest in.
Yep.
Balance sheet strength, management strength, and the ability for them to create cash flow.
That's exactly right. And getting back to your earnings question, I mean, if we take a kind of a macro view, 2023 earnings expectations at one point in time, getting back to last year, had been almost $250 in earnings. That estimate now is just slightly above of 2022 earnings.
Yeah.
We can, reasonably assume that 2022 almost entirely done at this point, or more than half of the way through earnings season. It's looking like $220, $218 to $220 in earnings in the S&P for 2022. Estimates for 2023 have come down to, call it, 220 to 225, where you have negative year-over-year earnings growth for the first half. And it's still positive for the second half, almost to wash out. But again, it's reasonable to expect that we're still in this downwards earnings revision period.
Right.
I think what's good for the market is, if we look at the historical lens, the market has historically bottomed before the trough in earnings and economic data, but it hasn't historically bottomed before a recession has started. And now we're getting a lot of this no landing, soft landing narrative. And, again, based on, the Atlanta Fed's GDP estimate for Q1, which is now around 2.4%. I mean, we're not there now.
Right.
but it could happen fast. I mean, how stretched is the consumer from a debt perspective and spending? So, this just could
you hear
still take time.
stats from the credit card companies that the consumer is starting to be stretched really thin,
Right,
in terms of cash flow, and
right.
that will show up at some point.
Yeah, it's just kind of a long slug is the way that we're looking at it. I mean, yes, we could avoid,
but that makes sense though, right? I mean, if we're in the sort of longer, slower, declining growth phase, I mean, we took a long time to get here in the sort of hyper low interest rate growth phase, right? So,
right.
I mean, it just makes sense on the other side of that mountain for it to come down a little bit. It's going to take a long time.
That's exactly right. And, going, in terms of valuations, if we tie that into earnings, and, the S&P's at 4130 today. And, if estimates are 220, if we're about break even on earnings from 2022, now we're looking at a 18 3/4 multiple.
Yeah.
If earnings continue to get down and we're at, call it 205, now we're over at 20 times earnings in a higher rate environment. It's tougher to justify significant, at least on a longer term sustainable basis, in market price. Of course, we can see, again, going back to, the technical analysis lens, oversold conditions can still continue to play out, and this market can surge higher. But from a sustainability and ultimate path trajectory, it's tough to.
So getting to portfolios, we talk about risk-adjusted returns often, right? And how do you mitigate the risk while still getting return?
Yeah, this is a year which is just a classic, humble example for investors to just keep the diversification discipline.
Yeah,
it's so easy to have written off, some of the underperformers now for the last 3, 4, 5 years. I mean, small cap value is quietly up 13 to 15% year to date. International stocks are up almost double digits, with generally lower valuations and perhaps currency headwinds with a weaker dollar on a longer term basis behind it.
A well-diversified portfolio will have pockets of strength in there,
and it happens fast.
And it happens fast, and it's hard to predict. It's hard to predict which part of the portfolio will actually have, be the strongest part of the portfolio, and vice versa, the weakest.
Right.
I think we were just talking with an investor this morning where they were over concentrated in value stocks for a long period of time, and today it's that concentration sort of is nice to have, but for the entire bull market in this large cap growth.
Right. And now we've seen the pendulum shift, right? Large value last year was significant outperformer relative to growth, but so far year to date, growth is
back.
Growth is has caught.
And you don't want to be like, hey, diversify over thousands and thousands of different investments, right? But you definitely don't want to over concentrate in sort of one investment discipline, because it gets you into, sort of higher highs and lower lows inside your portfolio. So
we've talked about the temptation too on the fixed income side of just grabbing short duration, 6 month, 1 year treasury bills at 5% plus. That's great and does make sense, but we just have to remember, none of us, generally speaking, are investing for the next 6, 12 months.
Right.
We're investing for years and decades. And so, if you look out further on the curve and, recognize that the 10-year, is approaching prior peak levels around 4%. I mean, those are 10-year returns if held to maturity at 4%.
Right.
As opposed to a recessionary scenario where the short end goes down again, where if you lengthen duration again for a part of the portfolio, you're looking at that, let's call it 4%. But again, in a recession, yields are going down, so you have a total return proposition.
Capital appreciation opportunity there that most people forget to think about. We joked the other day with Paul Gabriel, our capital markets guy, 40 years in the business. Rarely do you find a moment where Paul Gabriel is bullish on the bond market. So, it's always fun to see him positive and bullish. Most of the time it's our equity position analyst, but Paul's bullish and feeling great. So I don't know anything else. I think we've covered a lot. Talked about portfolio fed, earnings, and of course the market. So John, thank you for your time as always. Enlightening and fun conversation. And thank you for the opportunity to be stewards of your wealth and allow our Krilogy wealth advisors to take care of your portfolios and your financial life. So for John McArthur, I'm Kent Skornia. Thanks again and have a wonderful day.
Thank you.